So let's discuss the numbers and valuation that makes Chipotle stock a good buy. Before doing this, I do highly recommend you watch the first video because there are a lot of qualitative factors and important information that we give that create the basis for the underlying assumptions we make in this video to derive the numbers that we do. It's also important to consider that from here on forth in this video, when we talk about valuation, it should be noted that we are evaluating Chipotle from a sales and revenue perspective. So we're not looking at it, for example, from the perspective of their earnings, which is bottom line. We look at it from their top line. The reason we do this, and often is a common method in the industry, is because Chipotle's earnings are not normalized. And when a company's earnings are not normalized, it's very hard to forecast them and make any type of valuation about them. Now, in this specific case, the reason Chipotle's earnings are not normalized is because, one, they don't do any franchisees, so they pay for new stores out of pocket, and they open a couple hundred new stores every single year. And two, because they've had a few unfortunate sanitary outbreaks, their sales per store has been very volatile and has a lot of ups and downs. So for those reasons, we're going to be looking at Chipotle from the price to sales ratio and their EV to revenue, which is basically their revenue relative to the whole size of the company. As it currently stands, Chipotle stock is fairly cheap when we look at it from a price to sales ratio. A fundamental concept in financial and investment analysis is if a group of companies are similar in the industry that they operate in, or their business model is similar, and if their geography is similar, meaning the countries that they do business in, and they're similar in size as well, then they should be, for all intents and purposes, selling at a similar valuation. It makes sense, right? For example, if two banks are similar in size, similar in their business model, and similar in where they operate, there should be no reason why one should be selling at a huge discount relative to the other. However, when we look at Chipotle's price to sales ratio relative to its peers, we see that it actually indeed does sell at a substantial discount. But whenever you find one company that sells at a discount relative to its peers, it often requires more digging and careful analysis, because often at times it can also present an opportunity. To further add to this, we see that Chipotle is also at a substantial discount to itself when we look at the history of the company. If you look at the price to sales ratio right now, which is 2.650, it is almost at its all-time low when we compare it to where it has been. Here's a graph to represent that. Its 5-year mean has been 3.932. The price to sales ratio is essentially how much revenue the company makes on a per share basis relative to how much the price of the stock is. So it's essentially telling you how much revenue per share is associated with the share that you're buying. So the lower the price to sales ratio, technically the better. The higher it gets, the more overvalued it gets. Additionally, with being cheap today, the stock has a lot of growth prospects that many other companies do not. We identify 3 growth prospects associated with Chipotle that make it an attractive buy, in addition to its low price to sales ratio. So the 3 opportunities with Chipotle that we think will lead to strong revenue growth is its growth from existing stores. So Chipotle's sales per store is finally starting to creep back up. Their E. coli outbreak was in 2016, and this really changed the public's perception of the company. However, often is the case, people become forgiving and they become forgetful of what's happened in the past. To further add to this point, Chipotle has invested a lot of money in regaining the public's trust by offering incentive programs. They've given out some few million burritos just to try and bring people back into the store and regain the trust. If you look at their sales growth in the last few quarters, you can see the trajectory is pointed in the positive direction. We're looking at a revenue growth of about $510 million. Number 2, in addition to the stores they have outstanding, Chipotle is still in high growth mode, which means they're still opening many more stores. Right now, Chipotle isn't too focused on the international stage because they really want to lock down the domestic stage, which is the United States. Management has quoted that they expect to open about 130 to 150 new stores in 2018. This is a big deal for Chipotle because as they open new stores, it increases the chance for them to further continuously bringing up their revenue streams. So given the estimation of about 130 to 150 new stores that they plan to open, and if we multiply that by the average sales per store they've been making, we look at a potential $285 million growth from their new store openings. And the last growth opportunity that is huge for Chipotle is the introduction of the breakfast menu. An independent study by the NPR group concluded that breakfast is actually the fastest growing meal segment today. The NPR study also points out that breakfast accounts for 20 to 25% of companies' revenues. Their CEO Brian Niccol has already pointed out in management comments that he intends to implement the breakfast menu. Now I can say with a great deal of confidence that he will be successful in implementing this one because he was successful with the breakfast menu when he was a CEO at Taco Bell. And because burritos and wraps are the common breakfast menu item, Chipotle already succeeds in this area, the transition should be rather smooth. Now, if we were to see a 20 to 25% jump in revenues, that would lead to an increase in revenues of about $800 million. So these are the 3 prospective growth opportunities that lie with Chipotle. Here I have a bridge chart which shows where they are in terms of their revenues in 2017 and the 3 growth opportunities that I represented. As you can see from this chart, if they were to be successful in implementing what they have set out for them, their revenues would be at $6 billion. Now, Chipotle has 28.56 million shares outstanding. If Chipotle hits their $6 billion in revenue in the 1 to 2 year time horizon, and we divide that by 28.56 million shares outstanding, we get a revenue per share of $210. If we look at where the price to sales ratio of Chipotle is today, as well as what its average has been historically, at a $210 revenue per share, we see a price target for Chipotle at about $550. Our analysis points to a 25% upside, and our recommendation is therefore a strong buy. Just a disclaimer, we at Elevate Investments are long equity shares in Chipotle. It should also be noted that all the data and points given in this video are contingent to the time that this video was published, and that any investments you may choose to make should not be made solely based on the purpose of what's said in this video. We highly recommend you do your own due diligence and at times speak to a financial advisor or investment professional. I want to thank you guys for listening to this video. Please share, subscribe, like, and give us some feedback, and we hope you have a nice day. Take care.